Like we're all about settled. Hello and welcome to today's webinar, Geopolitics, Rising Inflation, Market Volatility, oh my, led by AAII's financial analysts, Wayne Thorp, Charles Rotblut, and John Bajkowski. Thank you for joining us this afternoon. We are happy to have you all here. So my name is Jennifer Shear and I'll be your host for today. I do want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And a handout of the presentation is available under the handout section of your GoToWebinar control panel, located on the right-hand side of your screen. And if you have any questions for our speaker, please submit them using the questions section of your GoToWebinar control panel. Our moderator for today is Pete Nugent. Will select questions and he'll submit it and read them aloud for the benefit of all watching the broadcast. And then questions that are not selected for the broadcast will be reviewed and addressed afterwards. And if you happen to experience any issues with the audio or the video of the webinar, please consult the instructions on how to change your device's settings, or you can consult the GoToWebinar control panel or website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with all the links to this presentation's handouts, as well as any resources we discuss. And for any of our new viewers, we'd like to give a little background about our organization. The American Association of Individual Investors is an independent nonprofit corporation formed in 1970 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And with that, I'd like to hand over the presentation to our web editor. Take it away, Pete.
Thanks, Jenna. Good afternoon, everyone. My name is Pete Wynn. I play a role as the web editor at AAI, where we're continuously listening to AAI members to help enrich your learning experience. I'll be your moderator today for a special presentation that we've put together that addresses concerns that many of you have had about this market environment. Feel free to ask questions the entire duration of the presentation. I'll find opportunities to get these questions answered. But the reason you're here is that we've heard your concerns about rising interest rates, inflation, the Russia-Ukraine tensions that have led to volatility, and we've seen the recent rise of bearishness as measured by the sentiment survey. And our editors have noted questions about whether to stay invested or whether you should alter your approach. And it's completely understandable from a human emotional level why investors have been unsettled by the news. You often hear that you should tune out of the market's noise and not pay attention to turbulence. But we recognize that it may be hard to do without calmer voices to help provide some basic perspectives. So as our expert analysts will explain today, it's always easier to take comfort and guidance from the context of history. The adage of history doesn't repeat itself, but it tends to rhyme is helpful when considering how the past may help educate you on how to respond to the present and future. So we hope that you're going to walk away from today's presentation understanding the cost of panicking versus the benefit of having a good plan. You'll have some answers to the question of, is it different this time? And you'll learn how successful investors guide themselves through market fluctuations and what tools that we have that you can use to your advantage. Speaking of successful investors, to help guide you today, we've assembled 3 analytical heavyweights to help share their fascinating insights. They've seen this movie before dozens of times, and they have very compelling and interesting research to share with you today. Doing the math, I think I came up with 93 combined years of professional financial experience between the 3 of them. But I'm joined today by John Bajkowski, president of AAI, Wayne Thorp, senior financial analyst and the head of research and analysis, and Charles Rotblut, AAI journal editor and architect of the Prism wealth building process. So without further ado, I'd like to introduce everyone, and let's start with John to do his introduction.
Thank you very much, Pete. And as a heavyweight here, like a senior spokesperson here, I mean it's a challenge. And I actually, my first full-time year at the association was back in 1987, and I lived through the terrible October there and the emotions that came with it. But they also then lived through the market responds to that. And over the years, I've interacted with many of our members, and I remember talking to a membership group shortly after the Kuwait invasion and the bearishness that existed there. And it's, you know, as Pete said, history may not repeat itself, but it does often rhyme. And, you know, one of the things that you find, no matter how difficult it is or how emotional you are involved in the marketplace, the more often you go through these steps, the easier it becomes. And, you know, you tend to see that with our more elder members who've been through this more than one time. They know what it's like. In fact, they like to use these opportunities to buy. And I'm not saying it's a buying opportunity, it may or may not be, but you know, it comes down to, as investors, we have to have a specific path in mind, a specific pattern in mind, how we want to get there, how we're going to get there, and you know, be opportunistic when we can, and hold the line when it's appropriate to do so as well. So you know, with that, I'd like to introduce my other partner in crime here, Wayne Thorp. Please take it away, Wayne.
Thank you, John. So yeah, I mean, I've been with the association almost 25 years. I started in 1997, so my first real taste of market volatility was the dot-com run-up and subsequent bust. But you know, over the years, as John pointed out, you know, there's been multiple market bull and bear markets, and you know, over time, you sort of develop a bit of muscle memory, where you know, you understand, you know, as you go through these periods of volatility, and you know, hopefully over that, as you've added your experience, you have more confidence in your overall investment strategy and methodology. And you know, hopefully every time, you know, we don't like to see our portfolios take big hits, but at the same point in time, you know, history has been able to repeat itself in that there's always, you know, potentially a 2 or 3 year period of pain, but the market has always been able to claw itself back and then and rise above it. So it's, yeah, it's you know, every time it's painful, but hopefully each time it's a little less painful, and we develop that knowledge. And with that, certainly last but not least, my colleague Charles Rotblut.
Thanks, Wayne. And, you know, I can't think there's anything about our parents would suggest we've been through some bear markets. But, you know, I'm somewhat the new kid in the block when it comes to AAII. I actually came to AAII in 2009, right after the financial crisis. And I had been working for Zacks Investment Research, but you all can imagine me working in the financial industry, switching jobs right after we had that bad bear market. Wasn't necessarily the easiest decision, you know, a little bit scary from a career risk standpoint, but I knew AAII was a great organization, and we use the term family a lot inside the organization, and it's how we view things. But one of the things we've seen over time and time again, as John and Wayne has said, those who do not panic during down markets tend to thrive afterwards. And so part of the short-term pain you actually incur is really the price you pay to realize long-term returns. And we're going to get to that in a second, but one thing I want to point out is I do look at our AI sentiment survey, and every week we ask investors, you know, are they optimistic or pessimistic about the direction of the market, or do they expect it to be flat? And what's interesting is we see expectations change from being very optimistic to being very pessimistic, but we tend to see AI members' allocations really stay more of the course. There are changes in allocations from month to month, but in general, we do see allocations move less than the sentiment, which means our message is getting through, but it also means AI members tend to be a more disciplined group, a more educated group, which is wonderful, which is we want all of you to be very effective managers of your own assets. But corrections, pullbacks, bear markets do happen. In fact, since World War II, there have been 97 drops of the market falling, the S&P 500 in this case falling by at least 5%. And here's data from Sam Stovall at CFRA. As you can see on the slide, he describes or defines a pullback as a drop between 5 and 10%, a correction a drop between 10% and 20%, and a bear market anything over 20%. So if you add all three up, the corrections, the pullbacks, and the bear markets, 97 drops. So about once, approximately every 10 months, you're going to get the market dropping by at least 5%. And 2/3 of the time, even though that 97 number sounds kind of scary and every 10 months sounds kind of scary, 2/3 of the time when the market incurs a drop, it's a pullback, meaning it's a drop of between 5 and 10%. So most of the time you can weather those and not really worry too much. And I will say, even when there's a correction, I've rarely seen a correction occur where people aren't talking about recessions, aren't talking about bear markets. But as you can see on the chart, we've had far more corrections than we've had bear markets. In fact, we've had about almost double as many corrections as we've had as bear markets. And again, far more pullbacks. So when the market pulls back and you hear the market strategists on TV and people screaming that things are going to go badly, take a deep breath, because history shows that chances are it's going to be short in duration. Now, you do see on this chart two things, a duration and time to recovery. I'm going to show you a chart explaining those in a moment, but the duration is what is a time period from when the market reaches its peak and that drops to its bottom, and the time to recovery is a time from the time the market bottoms to it either fully recoups its gains, or in the case of the bear market, when does the market bottom and then regain 20%. And what you can see by these numbers is the market tends to take the elevator down, meaning drops in the market happen very quickly. You can really think about it as being akin to a Band-Aid. Rip it off, you have this pain, it's uncomfortable, but then it goes away. But it does take the market a little bit of time to get back. So the market's kind of taking the stairs, taking a little bit longer to go back up to normal. And this delay between the drop and then the recovery can drive people nuts. It can cause worry, but investors who stick with it tend to be rewarded. Pete, do you want to go to the next slide? And we saw this 2 years ago in the coronavirus bear market. We're actually around the 2-year anniversary or close to it of that bear market bottoming. We had a very rapid 33% drop. And so in this case, when the market took the elevators down, it didn't take your ordinary elevator. It took one of those high-speed elevators that cause your ears to pop. And so it flew down, one of the fastest bear markets we've ever seen. But then it took about 3 or 4 months to recover. So still a fast recovery from our bear markets. But if you just close your eyes, ignore the market for, say, approximately 5 months, and didn't touch your investments, there's a good chance back in 2020, your portfolio was back to where it was, and possibly even better based on what you invest in. So I think it's really important to realize that when you have these drops, realize they tend to be shorter than bull markets, and the pain tends to come quickly, but also tends to vanish pretty quickly. And John, I know you have some more data on corrections.
Yeah, it's there's some interesting information. This is a presentation, a slide that Ryan Dietrich put together, and he took a look at, in this case, drops of 10% or more, and what happened to the market, no matter whether it was a bear market or how long it continued. Typically speaking, 1 year later, on average, after a correction, the markets are up 24% on average. The median is 25%. 90%, or 9 times out of 10, 9 years out of 10, the market is up 1 year later versus where it was at the time of the market correction or the market turned down. 2 years later, if you go back one more year after that, again, 37% is the average rate of return. So, we're all used to, I think, bargain shopping when it comes to refrigerators, TVs, whatever it might be. The stock market, I think, is very unique. It's the one part where really, for the most part, we tend to avoid the market the most when it's on sale, and we tend to talk about it the most, get excited about it, feel fear of missing out the most when the market's hitting new highs. And so it's important to keep in mind that it's painful to be in a bear market. It's painful to be in a correction. It's painful when information is uncertain, but often that's the best time to actually be not changing the course, not moving out of the course, but actually staying in and understanding that the market probably will come back. And I'm a optimist. It's important, very important, to make sure you're invested in markets that do have the rule of law, where the president can't just take away your assets. So it's important to have that kind of information. Also, as a follow-up to that, he also took a look at corrections that were just between 10 and 15%. and the number of corrections that occurred. And again, very similar situation. Anytime you have even a slightly more severe downturn, on average, 1 year later, the market's up 21%. 2 years later, the market is up 36%. So we shouldn't be really viewing these downturns as a way to get out. In fact, I know that my colleague Wayne here has taken a look at, the tendency for big down days to be followed by big up days, because the difficulty with getting out of the market, and I think it's always a two-pronged decision, right? I'm out of the market, when do I go back in? I've seen a lot of members over the years, perhaps correctly, get out of the market, but then they're faced with that dilemma of, okay, when do I invest again? And they miss out on the long-term opportunities to come with the market. Wayne, do you have anything you want to share as far as the types of movements that occur, or any kind of situation that occurs as far as that is in play?
Sure. If we could advance to slide 9, I believe, Pete. Yeah, so, inevitably, John and Charles have alluded to this, whenever the market really starts to wobble or volatility starts to rise, as the lead analyst and editor of the Stock Superstars report, I start getting questions as far as people like, why are you still fully invested? And, are you modifying your approaches and everything like that? And it's only natural when the market really starts getting volatile, people start questioning things, and, they decide, should I be getting out of the market? Also, as a financial writer, you're always looking for that angle, but, inevitably too, it's not uncommon when you start seeing commentary cropping up when the market starts to get more volatile, discussing the impacts of your returns if you avoid the biggest down days in the market. So, being a data nerd, a numbers guy, I started looking at the market returns, but what I found was really actually quite surprising to me. In fact, avoiding the biggest up days has a much more significant impact on your long-term returns than avoiding the biggest down days. So this chart here, I looked at the period from January 3rd, 1928 to March 9th, 2022. And for those of you counting at home, that's 23,659 trading days. And if you were fully invested over those almost 24,000 days in the S&P 500, your total return would have been almost 24,000%. Not a bad haul over that period of time. But really what amazed me was that if you had missed the 10 biggest down days, only 0.42% of the total days over that period, your overall return would only have risen to roughly 26,500. So, missing those bad days actually didn't have that much of an improvement in your overall performance. But on the flip side, missing those 10 best days had a significant impact. If you'd only missed the 10 biggest days over the period of January 1928 through March 9th of this year, you would have seen roughly a 67% decline in your overall return to just under 7,900%. In these these days, you're looking at the biggest one-day percentage increase, which for market trivia was a 16.6% increase on March 15th, 1933. But sort of segging a little bit, we're not going to switch slides yet, but the segging to my next discussion is actually I also found that 8 of the 10 biggest up days in the S&P 500 since 1928 took place between Black Friday, October 28th, 1929, and September 5th, 1939. And that date is significant because actually that was the first trading day after Germany invaded Poland to start World War II. But it was actually, I think, the 3rd or 4th biggest up day in S&P 500 history. And so this highlights the fact that you tend to see the biggest up days when there's a severe market downturn. And so here you were seeing the distribution of the largest up days in S&P history taking place during one of the biggest bear markets. So while this data shows that missing the best and or worst days can impact your overall investment returns, it fails to highlight one very important thing, and that is that big up days and down days tend to cluster together. And actually, our next slide will show that. So here again, looking at the period from the beginning of 1928 through the end of last week, the blue dots indicate individual trading days for the S&P 500 where the market was either up or down at least 3%. So, you see there's that sort of gap, empty space in the middle of the axis of the chart, and that's sort of the minus 2.9 to plus 2.9% range. So any blue dots above the axis indicates an increase of at least 3%, and a blue dot below the time axis indicates a decline of at least 3%. And what you can see here is these dots are pretty fairly clustered together. You'll see some periods, I see just past 1969 where there's a couple of up days that are kind of outliers. But by and large, the vast majority of these large days are really clustered together. And you might ask, why was I looking at a 3%? Well, that is somewhat arbitrary, but the average daily percentage change of the S&P 500 over this entire period was a gain of 0.13%. So 3% is definitely well outside of that average range. But let's move to the next slide, and so we can zero in on one particularly memorable period in the market. And this was from October 2007 through June of 2009, which encompasses the financial crisis or Great Recession of 2008 and 2009. And here we see a much more compact area period in the marketplace. But again, we can see by and large, these blue dots again indicate moves in the markets of either an increase of at least 3% or a decline of at least 3%. So over this period, October 9th, 2007, the S&P 500 hit a new all-time high. And over the next 11 months or so, the market was kind of trickling downward, but we really didn't see many upward or downward big moves in the market. You can see basically from October 9th through the beginning of September of 2008, we only had 5 days where the market saw a 3% up or down day. And actually, it's interesting to point out that the 2 down days over that period were actually somewhat of an outlier, which is, again, rare, showing based on the analysis I looked at. But once, beginning of September of 2008, we're in the middle of the housing meltdown. You saw some pretty high profile financial institutions fail. And that's when you really start seeing these concentration of blue dots. You have September 29th, 2008, sort of kicked off the financial crisis. The S&P was down 8.8%. But then just less than 2 weeks later, you see an 11.6% increase in the S&P 500. And again, this highlights what I said earlier, is as the market was in a pretty severe downturn, you're seeing up days that are actually outweigh the down days. And this highlights again that you'll typically see the biggest up days in market history during significant market downturns. But just to show you how volatile this period was, between September 9th, 2008 and June 22nd, 2009, this was 198 trading days. And of those, 57 of those days, almost 29%, saw moves of at least 3%. So over that period, again, almost 30% of the days over between September 9th, 2008 and June 22nd, 2009, saw a move in the S&P up or down of at least 3%. And 38 days, or over 19%, saw moves of 4% or more. So that just shows you how volatile of a period it was. But then, as volatility started to tail off, I ended the period on this chart ends on June 26, 2009, mainly because that's when really the number of significant up or down days dried up. And between June 22nd, 2009, starting that day, it was 157 trading days until the next 3% move, which was also coincidentally a 3.1% decline on the S&P 500 as well. So, this really, to wrap up this section, actually we can to advance to the next slide. But really what I would hopefully be conveying with these couple of slides and the data I've presented here is that, with investing, you have to be prepared to take the good with the bad. If you are trying to avoid the big days, big down days in the market, that inevitably is going to turn us into market timers or even day traders. And I firmly believe the typical retail investor, the typical individual investor, is not equipped to be either a market timer or a day trader, and myself included. So in addition, if you're trying to avoid these big down days, inevitably you're going to miss the big up days as well. So that's sort of, and I alluded to this earlier, is that's in John it's the sort of the two sides of the coin. Is you can try to avoid the big down days, but inevitably you're also going to avoid or miss out on these big up days. So the chart I'm presenting here is it's showing you time, not timing, is the key to investment success, and having that long-term perspective. You might see jags and up and downs in this particular chart, but if you look at the long-term trend, it's up. And so I think that's really the important thing, is to have that longer-term outlook when you are investing.
And it's interesting. Those are great points, Wayne. It's funny. Norman here was asking though. It's like, are things different now? Because one thing to talk about, bear markets that are due to economic events. But Charles, you actually spent a little bit of effort in looking at situations when we have geopolitical, other kinds of events. Want to talk about that a little bit, please?
Sure. Pete, you want to go to slide 7? And so this is from Calamos Wealth Management. It's probably one of the most comprehensive tables I saw, where they looked at pretty much every geopolitical event since World War II. So I realize this is small, at the very top it says Pearl Harbor attack. We have the full table linked to in my investor update. You can find that in the archives. And some of these events, you can argue whether or not they're a true geopolitical event, such as the assassination attempt on Ronald Reagan. That was a lone shooter, going after Reagan specifically. And you have other things like the London subway bombing, which was a terrorist attack, and borderline whether it's geopolitical or really a specific group trying to cause problems. But you do overall see a lot of events happen. You have things like the Cuban Missile Crisis in here. You have the 6-Day War. You've got Iraq invading Kuwait. So you also do have wars in there. But what's interesting is if you look from the time the event started, so whether it was a single day event, whether something more lasting, till the time the market dropped, the average bottom was 4.8%. But what's interesting, if you go out 6 months afterwards, the average gain is about 4.2%. So typically an immediate reaction to the geopolitical event in terms of a down market, and then a recovery. And the speed at which things recovered obviously vary. Pete, can you go to the next slide? What's also interesting though is that the S&P 500 only fell by double digits 4 times after a geopolitical event. As you can see in the slide, a 20% decline after Pearl Harbor, a 13% drop after North Korea invaded South Korea. The invasion of Kuwait was followed by a 16.9% drop. And then September 11th terrorist attacks, the market dropped 11.6%. And it's worth noting that when you go out beyond the initial few months of reaction period, you do tend to see other things at play. For instance, in 1990, we had a recession going on. Following the September 11th terrorist attacks, we already had tech stocks crumbling because of the dot-com crash, and there's an associated recession with this. So in some of these instances where you saw drops happening and you saw the S&P 500 being down further out after the initial reaction period, there was often something else going on right now. And obviously when we're dealing with Russia, there's obviously concerns about, well, what if Russia defaults? Technically, they have defaulted, although I've heard on their bond payments, they do have 30 days to make the bond payments. For those of you unfamiliar with the situation, Russia has issued bonds that are payable in dollars, and because of sanctions, Russia doesn't have access to dollars to pay back the debt. So there's some concern about Russian defaulting and what that might happen. But by and large, what we tend to see happening is something else goes on in the market that's going to drive returns. Even when you look at Pearl Harbor, you're looking at the US was emerging out of recession. You saw a shift to military production. So geopolitical events tend to be very short term in their impact on the markets. And what drives returns afterwards, again, tends to be something else.
It's kind of
Pete, I believe you have a poll.
Those are great points, Charles. I mean, I guess we've been talking about the market now for half an hour, and in this case, I think Pete actually has a poll he could pass on for our members, and we're kind of curious to see what you guys have done as far as your personal portfolios are concerned. Pete, did you want to share the poll with us? And while we're taking for the poll results to come in, Pete, are there any questions that have come in that might be worthwhile talking about right now?
Yep, so quickly, the poll is, have you made any portfolio adjustments? So we're asking you to select one of the following. Yes, I've got money out of the market. I've been buying new investments. I've rebalanced my portfolio, or no, I haven't made any changes. So while we're waiting for that to come in, just a few questions that have come in here. This question from Marion, who asks, how does inflation affect the numbers and charts? What is the effect of the government printing money?
I'll take that. I think when you look at all the numbers, the market's really forecasting what's happened in the economy over time. And even when you look at the 1970s up to 1980, you had very high rates of inflation. And obviously inflation's elevated here, but all that's factored into the returns, and all the data we're showing reflecting what was going on in the economy, what the level of inflation was, whether GDP was rising or falling. All that's factored into what we're seeing now. So as Wayne and John alluded to earlier, history doesn't necessarily repeat, but it often rhymes.
Yeah, but generally speaking, though, even when it comes to inflation, in terms of the assets that one holds in a portfolio, one asset that really has been able to really push your wealth growth beyond inflationary issues has been the stock market. So the bonds are normally there, and probably shorter term bonds are there to help temper some of the variability year to year in your overall portfolio volatility. But it's really stocks that long term provide the ability to beat inflation. And part of it is the fact that when it comes to bonds, they're, except for inflation adjusted bonds, they're paying you back in less valuable dollars on the line. Stocks are the one element, companies are the one element that actually grow their earnings and adjust to inflationary pressures. And as such, as the returns grow, so will the prices eventually.
And so it says the poll is about 3/4 complete, and we have the results. We'll share that in a second here. Just one more question I want to get answered here by Bill. He asks, if an investor has concerns that valuation levels in the market are too high by historical standards, is that a legitimate reason for reducing market exposure?
Charles, I know you've done a number of studies on allocations over time, and we've been taking a look at valuation levels. What's your feeling when it comes to portfolio allocation adjustments? What's the best time? What's the best situation to make adjustments to your portfolio allocation? It's part of the whole Prism process, isn't it?
It is, and with our Prism wealth building process, we align your investment decisions to your goals. And I'm a big proponent of rebalancing myself, and I talk about that in the current issue of the journal. But I would just take a look at your longer term allocations based on your timing of your goals, when you need withdrawals, your financial and psychological ability to withstand volatility. All that plays in a role with what your allocation is, and just look at what your allocation is to stocks versus your personal allocation. So just to throw a random number out there, say your allocation to stocks is 60%, and maybe for you it's close to 80 or 90%, maybe it's a little bit lower. If it's close to that number, I would suggest not doing anything. Now, if you think, if you're over that number, you may want to consider paring back in your stocks and bringing it down to whatever that appropriate percentage for you is, whether it's 60, whether it's 70, whether it's 80, or lower, whatever number is right for you. I would just look at the number and bring your portfolio back down to that. Now, if you are concerned about valuations themselves, and you're holding individual stocks, then take a look at your sell rules and ask yourself, do I have valuations as part of my sell rules? For instance, with our shadow stock portfolio, we have very strict rules regarding valuations, but when John sells a stock or removes a stock from the shadow stock portfolio, it's reinvested into another stock, but that stock it's reinvested into has a lower valuation. So you could keep your allocations, but do some rotations within your allocation if that's appropriate for your specific strategy.
And again, it's important to think, chances are most people have allocations across multiple stock sectors or segments. It could be international, could be domestic. And you know, we've looked at valuations and we've talked about them in our investor updates and journal. And you know, the markets are not equally valued across all the different segments. Some sectors are cheaper than others. Some cap levels, small caps, are a little bit cheaper than large caps as far as their historic norms. So often it's possible to go ahead and find more attractive segments of the marketplace where you still want to have your toe in the water and take care of that. Because I think when we get into our next issue here, and you know, Pete, do you want to talk about the poll results here? I mean, before we move on to the next issue.
Sure. It's according to the poll, 47% of you have not made any changes to your portfolio. 13% have kept money out of the market. 18% have been buying new investments, and 22% have rebalanced your portfolio. So feel free to also comment, analysts, on the results, you know, and what you make of that.
I find it encouraging. You know, you've got almost half that haven't made any changes. So, you know, they aren't making necessarily knee-jerk decisions. You know, the 18% that are buying new investments, you know, so those are obviously the bargain hunters. You know, that's, even though market volatility has increased, there are, you know, if you have a watch list, you know, realistically what's happened in the market over the last few months hasn't changed the underlying fundamentals of some companies, many companies. So if you have a watch list that you would have been sitting on the sideline, there might be stocks in this watch list or investments that are actually more attractive valuations. So you might be buying things at a more attractive valuation. So, you know, I'm encouraged by those numbers.
Charles, any thoughts before you move on to your next presentation, next slide here?
No, I just want to say I agree with what Wayne said. And when we look at our asset allocation surveys, we've seen a slight drop in the number of people who have how much of their portfolios allocate to stocks, the percentage of members who say how much of their portfolios in stocks, but it hasn't been very big. So it really it backs up what we're seeing in the poll right here, where a lot of members are not necessarily changing their portfolio, or at least maintaining their equity allocation, which might tie into the rebalancing.
That's good, because when it comes to timing, I think timing isn't necessarily your friend. Is that what you're going to say here?
It is not. And, you know, it's interesting we just got that question about valuations, because one of the things I've done is I looked at what happens if somebody gets out of the market. And in this slide in front of me, I looked at what if a person, you know, started investing at 2000, and specifically what if their timing was bad. And so, you know, we had a question asked about high valuations. Well, arguably in 2000, things were, you know, even more ridiculous when you had companies like Pets.com generating very high valuations. And obviously, setting aside the meme stocks of today, putting that aside, it was a very high valuation market, particularly among stocks associated with the dot-com bubble. And so what I did is I assumed three scenarios. A person started out in 2000, bought a portfolio that's basically 60% stocks, 40% bonds, and either they just let the money ride, did nothing, they rebalanced periodically to maintain that 60-40 allocation, or they panicked. In all three scenarios, they started out with $100,000, a nice round number. So in the panic situation, I assumed that whenever the S&P 500 fell by at least 20%, meaning fell to a bear market during a calendar year, the investor got out and stayed out of the market for just 1 year. And I will argue that 1 year is probably somewhat conservative, because when we tend to see people panic, they tend to wait for the all clear sign before they get back in. And by that point, the market has really rised. But what's interesting is if you only got out of the market twice out of the last 21 years, you would have, if you versus an investor who rebalanced their portfolio periodically, you would have forfeited $500,000, meaning you would have started off with $100,000 and you would have just given away $500,000 simply because of your timing decisions, simply because you're worried about the market, you're worried the market was going to fall, it was going to keep falling, you couldn't stand the pain. That's a huge forfeiture. Now, what if you're the person who's more aggressive? You did it once and you just didn't touch your portfolio at all. That investor would have had $900,000 more dollars than the person who panicked. So again, if you panicked, your forfeiture of wealth, even if you're out of the market for just 2 out of the last 22 years, would have been between $500,000 and a full $1 million of wealth. That's a huge amount of money that you're just giving up by going to your emotions. And Pete, do you want to get to the next slide? Because I know people are hearing, well, those are really big numbers, and surely investors don't do this. This is an ongoing study by Morningstar that looks at the return gap. Carl Richards and other people also refer to it as the behavior gap. And it's basically, what's the return investors in ETFs and mutual funds are realizing versus the return the mutual funds and ETFs themselves are actually gaining. So over the last 10 years, your typical mutual fund, your typical ETF has realized a return of 9.4%. Pretty good. The investors holding those ETFs and those mutual funds have realized a return of 7.7%. So the investors, individual investors on average, not hopefully AAII members, but on average, are giving up 1.7% in annual, so 1.7 percentage points in annualized returns through their timing decisions. And that's a huge amount of wealth they're just giving up, simply, again, because they're basing their decisions on what they feel, what they think might's going to happen, what is happening that has them worried. And I think when you look at this chart, it goes back to one really great piece of advice I heard from James Montier at Asset Manager GMO. If you don't know what's going to happen, don't structure your portfolio as though you do. In this case, if you have a really good fund, you have an ETF, it still meets your reasons for why you purchase it, just stay with it. If it's a well-managed fund, a well-managed ETF, you're going to end up with good returns over the long term. Obviously, it depends on the fund and where it's allocating it, but as you can see, there's a huge penalty to panicking. And John, I know you have some data on flight to safety as well.
Yeah, and I think just adding on to this a little bit, I mean, the whole notion here and why the return gap exists is that too often, we're piling into funds that have just performed well, whether it's a 1-year basis, 3-year basis, or even 5-year basis. So it's critical as investors, and what smart investors do is when they look for funds to invest in, they don't really compare funds against different categories of funds. So it's very important that when you analyze a fund, when you're looking at a fund you want to invest in, you compare the fund against its peer group, you make sure its expense ratios are low, and when you evaluate moving out of that fund, you look for alternatives in that same category. And that's, I think, that's something we really talk about here a lot at the association. That's why a lot of our members aren't necessarily panicking now either, because they understand the importance of doing logical comparisons and understanding how the different kinds of performances should be performed and how they should go ahead and select mutual funds and whatnot, which is, brings us to the whole notion of flight to safety. And, anytime, I think you're looking at the market that occurred at the start of the coronavirus pandemic, and we had this tremendous bear market, very short-lived, but very severe, and the quick turnaround that came back after that. Last year, the market was so steady. We had, with maybe one 5% pullback, nothing really too dramatic last year. We kind of were lulled into a sense of security. But anytime you have these are the times that test our market structure, test our portfolio allocation structure. They help us determine if we're set up in the way we want to be long term. So, make notes now. If this is not what you can live with, you can potentially take parts of your money, make sure you still have the overall allocation and plan, but you can go ahead and find some safe havens. And normally speaking, we're talking about safe havens. I mean, the safe havens are your U.S. government treasury bonds. For some people, it's gold. I'm personally not a big fan of commodities when it comes to safe havens. Other worldwide investors look at the U.S. dollar, Swiss franc, but really for most investors, you're going to look at short-term U.S. treasuries are your safest bet. They are not going to default. I mean, a lot of discussion occurs perhaps on politically situations as far as that happening. But the other question that comes up often is, okay, if I'm going to be invested in U.S. treasuries, and what are my other options as far as safety? And one element, and you know, I think Ned Davis did some research and found that, you know, dividend payers, low beta, is kind of a chance to stay invested in the stock market, gain some of the benefits of being involved in the equity participation of long-term rates of return, yet being invested in an asset class that's a little bit less volatile than most stock markets. You get paid the privilege of holding them. For the most part, it's one way to stay involved in the stock market, but not get that same level of high risk, high volatility that you might get with other asset classes. You know, so again, it's the whole notion of dividend payers being a little bit less volatile than other market segments is one way to stay invested, yet go ahead and participate in the market as far as that is concerned. And you know, as far as that goes, Charles, you know, when it comes to how one goes apart and structures their portfolio, you know, often we look at it as a overall portfolio. There are techniques where you could potentially look forward to where you're investing and perhaps set up asset allocation pools for those types of times. So like if you're in retirement and you want to make sure there's enough cash available for you, you can have perhaps a way to do that. What are those types of things called, and how would you go ahead and look at some of those opportunities?
Sure, John. And there's two ways of doing it. One's a bucket strategy, and the whole idea behind a bucket strategy is you're allocating your portfolio by time. When do you need to withdraw money? And there's different versions of this. I'm using a very simple 3-bucket strategy here, and the time periods also vary. But the idea is the money you need to withdraw within the next few years, you're allocating very safely. You're thinking CDs, money market funds, maybe savings accounts. So the idea is you're limiting the volatility. You're limiting the chance that you'll incur a capital loss. Your intermediate time period, I'm using again 3 to 10 years, and depending on who you ask, you'll get different time periods. But you're taking some growth, trying to get some growth of assets. Maybe you're looking at, you know, more traditional dividend payers, less low beta dividend payers, holding some high quality bonds in there with shorter maturity dates. So you're getting some income, some growth, but you're not taking on too much risk. And then money you won't need for at least 10 years or longer, then you're actually taking a lot of growth. You want to be aggressively allocated. And again, the number of buckets you have and the time frames is variable, but the idea is you're segmenting your portfolio by time. When do you need the money? The sooner you need the money, the less risk you're taking. The further out the money, the more risk you're taking, because at the very short term, preservation of capital is really important, because if there's a sudden drop in the market and say you need money to spend in a year, and that money you need to spend falls in value because you have it allocated fully to stocks, you may not have enough time to recover to meet your expenditures. Versus if you're looking at a goal, say 20 years out in the future, then you really need growth of capital, because your big risk is not market volatility, it's inflation and protecting your ability to buy goods and services with the dollars you have, a concept known as purchasing power. Now, a twist on this is something that Jim Clunan uses and other people use as well. Jim Clunan, our founder, called it the level 3 defensive strategy, but it's also a play in what's known as a buffer assets. And a buffer assets is something used for retirees can use, but other people can use as well. And the idea is if you're taking portfolio withdrawals, so maybe your retirement, you're depending on your portfolio to fund living expenses, or perhaps you have some kids and they're about to go into college, or you have some other expenses are coming up. The idea is you segment your portfolio. Part of your portfolio under a level 3 approach is invested very aggressively. Clunan recommended being fully in stocks. And so you have that, and your idea is you're trying to maximize your growth. The buffer point comes in terms of cash. And so Jim Clune recommended between 2 to 4 years of cash. Wade Fowle in the current issue of the AI Journal is suggesting having about 3 years of cash in it. So right in the middle of what Jim recommended. But the whole idea is that you have two different segments of your portfolio you can withdraw from. And so just to walk you through this table, as you're nearing retirement, say about 4 years before your planned retirement date, you start building up this cash bucket of between 2 to 4 years of living expenses. And so in this example, you're building up 4 years of living expenses. You estimate you'll need $50,000 from your portfolio each year. So you're building up your portfolio, provided the market is near its high. So the market pulls back from its high. Clune used a number of 5% below its high. That puts you in a defensive position. That number is up to your number, but you're using when the market's at high, you're taking money out of stocks to build up your defensive bucket. And then once you're in retirement, then as long as the market's near its high, you're withdrawing from stocks. But you can see here, in this example, we show 2027 being a down year for the market. And obviously our crystal ball isn't that good. So we're not saying 2027 is going to be a down year, but in this example, assuming it is, this is when your buffer assets kick in. So instead of selling stocks, you're leaving the stock portion of your portfolio alone, and you're withdrawing of those buffer assets. In this case, that reserve of 4 years of expenditures in the cash bucket. So what that does is it prevents you from selling stocks when your portfolio is down, allowing the stock portion of your portfolio a chance to rebound. Now, if the market stays down again for a couple more years, you keep withdrawing from that buffer asset. The buffer asset's designed to prevent you from selling stocks when they're down. And then once the market rebounds, then you go back to withdrawing from your stocks, but you're also taking a little extra out to replenish your buffer asset in case the market, falls again. You don't have to sell stocks. Now, Clune recommended actually refilling that buffer asset. As you'll see in the journal, Wade Fowle says you may not need to. If you use that buffer asset just once, you may not need to again. And so there are some disagreements about how this works, but the whole idea is if you have some safety valve that you can tap into when the market's down and not sell stocks when the market's down, you're going to have a better outcome, not only for retirement, but really for any long-term goal that you're trying to fund. And Wayne, I believe you had something on some defensive strategies we could use for investors as well, in addition to the buffer assets.
Oh, Wayne, I'm not hearing you.
Can you hear me now?
Yes.
Hear you now, sir.
Yes.
Interesting. It's not muted. So yes, so as we are entering in some more volatile times here, there's a couple of ways as AI members to be able to identify screens, especially on the stock side of things, that might identify either approaches or underlying stocks that might be better adapted to more volatile or perhaps bear markets. And so if you go to the AI.com at the stock ideas area, we have a tool called the power rankings. And with this tool, you can rank the 60 or so stock screening strategies that AI has developed and tracks. And you can sort them, these approaches, by a number of different variables, performance, 1, 3, 5, 10-year, risk-adjusted return. But you can also look for how they performed over the most recent bull and bear periods, as well as by their overall risk index. So this slide here shows you ranking our strategies, stock screening strategies, based on how they perform best over the last bear market. And that basically was the very short but strong downturn in the market in February and March of 2020 at the beginning of the COVID pandemic. So you can see here are 4 of the strategies that performed best over that period. The market actually, the S&P 500 over that period, just almost hit a bear market over February and March of 2020. I think it was down 19.9% over that period. Here we see that the Investword Quality Growth Screen actually gained 6.7% over that 2-month period. So really bucking that trend. You see the foolish small cap 8 revised screen actually had a 0% change over that time. I can almost guarantee that that was probably attributable to the fact that it had no passing companies over that period of time. So in effect, it was out of the market. But then you can also see you have the Philip Fisher screen as well as William O'Neill's CanSlim screen, marginally lower returns relative to the overall market. So again, this is one tool that you have access to identify screens and how they performed over the most recent bear period. But then the next slide also shows you're able to rank our stock ideas based on their risk index. And the risk index is basically a measure of volatility relative to some benchmark, in this case, the S&P 500. And a risk index of 1.0 means that the monthly volatility, the volatility of monthly returns, the volatility of monthly returns for these different approaches matches the monthly volatility of the S&P 500 over whatever time period you're looking at. I think in this case, it's 36 months. Here we see that the Graham Defensive Investor Utility Screen has a risk index of 1.05. So that means that in effect, it has a volatility of monthly returns that's 5% greater than that of the S&P 500. So we have the dividend high relative yield, a risk index of 1.07. So again, that indicates that its volatility of monthly returns is 7% higher. So this is a way that you can identify, screens that tend to be, at least relative to each other, less volatile. We have no screens that are less volatile than the overall benchmark. But if you're looking for trying to insulate yourself from overall market volatility, perhaps looking for strategies that have lower volatility as well. But it is also worth pointing out that there is that risk return trade-off. And so, for example, the Graham Defensive Investor Screen, which has our lowest volatility, also over the long term does have relatively poor performance, quote unquote. I think it's up roughly 386% over the back testing period. And I think the median return of all of our strategies, I think is like around 1,300% or something like that. So, obviously, the overarching discussion is, not all approaches are going to outperform the market over all periods of time. Some inevitably are going to outperform others depending on the market environment. But again, if you think that the market is going to go through a prolonged downturn or a period of increased volatility, and you're looking to perhaps diversify your portfolio across different strategies, then here are a couple of methods that you might be able to identify some approaches that might meet this particular market environment. And with that, I think I will toss it back to Pete, I believe, who we might have another poll. Is that correct? Or did I just throw you a curveball, Pete?
No, it's we're trying to get a sense for how our sentiment is a very important thing that our members are often involved in. And Pete, I think there's a poll out right now talking about their outlook going forward. Want to tell us a little bit about the poll and what kind of answer we're looking for?
So, yep, most of AI members are familiar with the AI sentiment survey, but the poll question, and we do this every week, but we're curious about what this poll looks like in this audience. Over the next 6 months, do you feel the direction of the stock market will be up, bullish, flat, neutral, or down, bearish? And so while we have the questions, the poll results come in, we can start doing some Q&A now, I believe. So I've got a lot of questions here. Some of them are very specific. This is an interesting one from Jan Wilkins. So I'll open this up to our panel here. What do you think about using inverse ETFs as a protection during bear markets? Do you think it's a relevant hedge? What's your take on that?
Yeah, I'll chime in on that.
I'll jump in on So go ahead, Charles.
Oh, sorry. Okay. No, I was to say, I think I'd be really careful when anytime you get to leverage or inverse ETFs. I mean, they're generally designed, you have to look at, most of them are designed to be held for one day. And the problem is, depending on what they're actually holding, there can be some big issues. We recently had 2 exchange traded notes have issues. In fact, Barclays just closed 2 exchange traded notes, VIX on oil, because they're worried with all the volatility going on. So I do think these are they're very specific trading vehicles, and you have to look at what they're designed to do, and you may end up with returns that you don't expect. And in some cases, depending on how leveraged they are, they can actually implode.
Thanks, Charles. Let me read the results of the poll, and then we'll make some commentary on that, as well as this slide here. So it looks like 46% of the group say that they are neutral, 28 say that they are bearish, and 26% say that they are bullish.
How's it compared to the averages there, Charles?
That actually, the neutrals are well above the average. Historically, we've seen neutral sentiment be about 31%. So much more neutral than we've been seeing in our sentiment survey, and certainly more than we've seen recently in the sentiment survey. We've seen bearish sentiment being unusually high, as I mentioned before, optimism being unusually low, but we have seen sentiment be a contrarian indicator. And although there's that saying, buy when there's blood in the streets, when you look at our sentiment survey and what's happened when people who say they're bullish, optimism is unusually low, that's historically been linked to higher than average returns over the following 6 and 12-month periods for the S&P 500. So generally, when people are afraid to buy, it's usually a sign there's something going on in the market that's giving people concern, pushes down stock prices, and leads to higher returns going forward. But I do want to emphasize that sentiment's not causal. So we see a link, but low sentiment itself does not usually drive higher returns. Usually it's a sign of something else going on.
Does it mean perhaps if you have an extended period of bearishness, is it perhaps that all the sellers have been shaken out of the market and the only thing left are buyers to come in? How would you interpret the results, Charles?
Well, I think what you're really seeing is, yeah, right, a lot of times it's sellers exiting the market, but I also think you see the buyers going on strike enough that you see the bargain hunters looking around saying, if nobody else is buying, I'm going to open my wallet up because I'm finding bargains now, or I think stocks are being mispriced. So you see the opportunists really step in, realizing there's good opportunities, and they start getting greedy. And once you start having the market take off, then your more momentum-oriented investors start jumping in as well.
Makes sense. Any other comments about sentiment before we open the floor to questions, overall questions, Charles?
No, I don't.
Well, thank you. Again, I want to thank all of our members who do regularly participate in our sentiment survey. We've been doing this since, I believe, '86. And back in those days, we actually used to send out a postcards in the mail, and members would respond back via the post. If you actually tabulate these results, we'd pull all the cards out, we'd break them up into 3 chunks and count them up by hand. Since 2000, we've been doing it digitally. So, you know, I guess I'm not sure what the future holds. Perhaps posting questions via, you know, our mobile phones might be the future. I don't know, Charles or Pete, you might have some comments as far as that is concerned. But as Pete said, there's a ton of questions out here. I know we've gone a little bit past our time, but we'll be happy to stay for another 10, 15 minutes to answer your questions as we can.
Okay, and then Jenna, if you can just remove the slide from the screen. All right, we got a question, quite a few questions here about bonds, but I guess it's a summation here from Greg Ford. Really, is there any significant reason to buy bonds?
Yeah, it's bonds. You know, there's 2 ways to look at bonds. One, they preserve capital. 2, they give you they really give you the nerves to buy stocks. And I think in the case of bonds, you do get the interest income. They do provide a balance in terms of volatility. Now, obviously, if you're financially and psychologically in a position where volatility is not an issue for you, you can weather down periods, then you could argue that you may not need bonds, perhaps maybe a small position in cash or money market accounts, so you don't have to take withdrawals when the market's down. But for a lot of people, having that balance, bonds actually work really well because they do provide low correlation with stocks. this said, I do think in this market you want to be somewhat creative. Obviously, I personally hold intermediate term bond fund in my own 403b plan at work, which is similar to a 401k to balance out the volatility a little bit. But for an individual investor, you could be looking at things like defined maturity bond funds, and these are bond funds that mature on a certain date. You could obviously, if you're really worried about a rising interest rates, think about laddering CDs, or just go shorter on the bond curve. Alternatively, you could buy individual bonds and ladder them so they mature at different dates, so you're taking the timing aspect out of it. But it does start with what is the right allocation for you, and what is your ability to withstand portfolio volatility.
And just adding on to that a little bit, when we're talking about buying a portfolio of bonds and laddering them, you're probably talking about treasuries, because you want some diversification. So your ability to buy corporate bonds and ladder them for individual portfolio is probably pretty limited.
Yes.
In this context, you're really talking about treasuries, which you don't have to worry about diversifying across industries and states and sectors. But yeah, I agree with Charles, and is that when it comes to bonds, there's not a lot of reason for most of us to go on the long end of the bond maturity ladder. You don't get enough rate of return to compensate yourself for the added volatility that comes with them. So short to intermediate term bonds seem to be the sweet spot. Intermediate seems to be the real sweet spot, where you get a lot of the return, an added yield premium from longer rates of return without as much volatility. And whether you ladder them through treasuries or hold a intermediate term bond fund, that seems one option to have that part of your allocation. That's part of the allocation models that you have, that you keep track of on our website. Do you want to tell members a little bit about that?
Yeah, absolutely. So you can actually go to AAI.com/asset allocation, and we have 3 models, and they're suggested models for how you can allocate. We do include them in our Prism wealth building process, but basically our aggressive allocation, that's about 90% stocks, and you could actually take up to 100% stocks, but it's for investors with a long time horizon who won't panic when the market drops. Our moderate allocation is a take on a traditional 60-40 allocation. So the 60% is actually diversified among stocks, large cap, small cap stocks, international, emerging markets, and then a 40% is short and intermediate term bonds. Our conservative allocations, 60% bonds, 40% stocks, and that's really focused more on trying to preserve capital while still providing a growth component by keeping that allocation to stocks. And so people can look at those. We actually tell you the exact breakdowns. We give you examples of mutual funds you can use to populate those portfolios. And obviously you can take advantage of our mutual fund guide or ETF guide to find alternatives to those funds and ETFs we're using as suggestions.
And Eleanor had an interesting question here, Pete. You probably had it coming up next on your list, but it was the whole notion of, when it comes to adjusting our asset allocations, there's different ways to do so. There's tax advantage, less tax advantage. I mean, we could change allocation actively or passively. We could potentially sell off. How do we adjust our allocation? I mean, if the market's down, you could sell off certain assets or put money in. If you're putting money in, if you're in a stage of your life, you're adding money to your portfolio, you could put money actively into those segments that are underweighted or more attractive. And if you're selling, or if you're in a withdrawal stage of your life and you actually pull money out of the market, you could be at that point in time selling off those portions of your portfolio that have a higher proportion, are overweight because perhaps they did well, or are overpriced. Any other observations as far as dealing with adjusting to your portfolio based on market conditions in a smart, tax efficient way?
I think I would add to it is, I think what you said as well, but if you're looking also at doing some rebalancing, take a look at your tax situation. If you're looking to do some rebalancing and perhaps you have some losses you can offset with gains, or perhaps you're going to be in a low tax year and you need to rebalance, so maybe use that as a time to actually take the gains in your your portfolio to keep your tax bill more steady from year to year.
So we've got a few minutes to go. We'll do maybe 1 or 2 more questions, and then a final word from the panel here. A few questions about the return gap. Charles, I know that was your slide there. David's question is, can the difference between the return investors receive against what the fund's return be due to that investors have good sized percentages of their investments in bonds, et cetera?
No, it's not from bonds. They actually, at the Morningstar, the methodology, they actually looked at the timing of flows. And so mutual funds, the term flows means when did an investor put money into the fund and when did they take it out? So they actually looked at the data on flows. When was money moving into those funds and when was it coming out? And that's how they actually looked at the behavior gap. So the return I showed you about close to 10%, that actually was the performance of all the funds they looked at.
So the key here is that what they're finding is that people are putting money into funds after they've had a big run up. And it's often the case of those funds then actually underperform or go back to the average afterwards. And they're taking money out after they've had a big drop. And that's actually the time that most people should be putting money into that asset class. That's how that gap occurs.
All right, we'll do one more question here. This is an interesting one. Valid observation by Ed, who mentions that a lot of discussion on the limited impact of geopolitical events on the market performance, but not much about the rising interest rates and inflation. So we'll consider that for a future webinar. But like just some thoughts from the group about those two things.
Well, it's interesting. The market didn't. The market didn't initially like the interest rate boost, but it looks like it's roared back. That probably, I would assume, perhaps the initial drop was, sort of like when you see a company issue guidance that maybe might catch the markets offhand. I think probably the higher than expected inflation forecast by the Fed. And probably then that'll lead to more interest rate increases over a shorter period of time. That was probably what was led to the initial decline. So that's about, I was just been sort of ticker watching as we've been going along, but it looks like that initial drop, at least by my inference, was that it's the higher than expected inflation forecast by the Fed.
And we did an article, I think it was, we covered the O'Shaughnessy small cap value strategy in the recent AAII journal. And a lot of that work came about on O'Shaughnessy's book that he made the importance observation that you really do need to want to take a look at the after inflation adjusted rates of return. And we did some work on that article. We did, I think, some work also on the shadow stock article that we published in actually online only back in January. And in there we quoted rates of return for different market classes using inflation adjusted figures. And again, bonds, cash, they basically keep up with the inflation rate. So they work as dampers to our portfolio. They help us provide a little bit of smoothness to our return over time. In terms of inflation hedges, making sure we have enough cash available to actually live off of our savings, live off of our investments. Historically speaking, the only real asset class that has helped us overcome the loss of purchasing power when it comes to inflation has been, I believe, stocks. And Charles, any other thoughts on that particular topic before we close for the day?
Yeah, we actually read an article a few years ago from Aaron Brask, and he looked at dividends, and he did find that dividends themselves, particularly when they're growing, are actually really effective inflation hedges. And so that's one thing you can look to if you're concerned about inflation is stocks with dividend growth. And I'll just throw a plug in our dividend investing newsletter. Actually is a portfolio of 24 stocks with growing dividends.
Well, I want to thank our audience out there for attending. We had a lot of questions that we did not answer. We read and review these questions after each webinar and try to get to them whenever we can. We also have a community area on our website. So Jenna, our community manager, is probably going to be weaving some of these questions into some topics in her discussion board management there. So I encourage you to go to the community and ask these questions there. We are very accessible. all of our analysts and experts here. Love answering and helping and assisting you out there. But we'll look for just a final word from John, Charles, and Wayne. I know it's hard to avoid cliches, but just any kind of one-liners that the audience can take away from this today. So
I just want to highlight again that the importance of having a long-term viewpoint. Don't get sucked into the day-to-day, and I think that will have less gray hair and probably be more beneficial to your portfolio in the long term.
Go ahead, Charles.
Yeah, I just say, if you get nervous about the market, that's okay. Just admit it. Turn off CNBC. Don't go to Yahoo Finance. Go take a walk. Play Wordle. Do something to get your mind off of what's going on. I think you'll find it reset your emotions and will lead to better decisions with your portfolio.
It's tough to tap that because emotional intelligence is critical when it comes to relationships, life, and work. But I guess I will say this one thing. In some ways, one does not play the market, and one does not try things out in real dollars. I think it's very important to do your research in advance, build your conviction in what it is you want to do and what you want to achieve, because you will be tested over time, and you want to have the understanding, the trust in the system that you have in place, that you can work with it through any kind of situation. In some ways, it's a bit like religion. I mean, it's I hate to equate it to that, but you have to really believe in it, and you have to be willing to understand it, even when you're being tested by it. And that's going to give you some long-term satisfaction and some happiness over time.
Well, thank you, everyone. Jenna, I'll hand it back out to you.
Yeah, I'm just going to go over, we have some exciting events that are coming up, so I just wanted to highlight those. And so we have the Individual Investor Show, Discount Broker Face-Off on Thursday, March 24th at 4:30. This show will actually delve into the annual AAII Online Discount Broker Guide, where we compare these various websites and apps based on key features such as security, trading, platform, resources, support, and so much more. So that'll be really exciting. Again, that's on Thursday, March 24th at 4:30 p.m. We also have the Prism Webinar, Selecting and Managing Your Investments, on Thursday, March 31st at 7:30 p.m. And in this webinar, members will learn how the Prism process uses your wealth building plan to select investments appropriate for your portfolio, as well as how to create those buy and sell rules that you can use later down the road. And of course, to view and register for upcoming webinars, visit aai.com/webinars. And to catch the newest releases of the Individual Investors Show. We made a little bit of a transition last week, which was excellent. But if you want to catch those shows, you want to subscribe to us on your favorite podcast platform. That means that we are on Spotify, Apple Podcasts, Amazon Music, Google Podcasts, and so many more. And before we wrap up, we'd like to take a moment to thank our sponsor, Discover Bank, with a quick video. And now for a message from our friends at Discover Bank. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner Discover Bank on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part, all of the deposit accounts offer preferred member rates. Take a look. With Discover, you can earn over 5 times more interest than the national savings average with preferred member rates and pay no fees. That's no fees, period. Plus, no minimum balance is required. You can access your AAII member savings account with Discover Bank from your smartphone or tablet, so it's easy to keep your money moving in the right direction. Open an AAII online savings account to start saving for the future today. Visit aai.discoverbank.com to learn more. Thank you. Big thank you to all of our financial analysts for showing us how to navigate uncertain economic environments and what AAII tools, screens, and resources you can use to lower your overall risk. And to mention again, this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this presentation's handouts, as well as any resources we discussed. And with that, we wish all of you viewing good health, good fortune, and a great afternoon. Thank you and take care.